Yeah, that's what I think. That's why we get to 7,000 or thereabouts. Call it in by the end of the year. Maybe I'm off on that. I'm not perfect. Like maybe it takes 12 or 18 months to get there. But yeah, I mean, that's why I think that's where we go. But is that going to be real S&P growth, or is that going to be nominal growth? But I think for investors, it's important to take a step back and say, how do equity markets work? How are they priced? And I think the gold market is telling you this. I mean, like I keep waiting for a pullback in gold. I do a lot of gold work. I sent a chart over on some Fibonacci numbers, like 32, 38 on futures, which is basically where we're trading as we're recording this, is a key level. Was expecting a pullback, as we hit this, and like at least as we're recording this, we're not seeing it. And what we're seeing is like gold like march higher. And when we do get pullbacks in gold, it's like it happens in like an hour. Like it drops 50, 60 bucks in an hour, and then an hour later. So it's testing the key levels that I watch, but it's not testing them for days or even hours. It's like testing them for like minutes. And then it's moving higher. And so like to me, I mean, 1971, right? Gold is $35 an ounce. 11 years later, it's over 800. That's a 25x increase in gold. A 25x increase in gold from where we were a couple years ago, like let's call it 2000, that's $50,000 gold. Do I think we're going to $50,000 gold in the next 10 years? Honestly, maybe. I think twice in history, the gold price has been higher than the Dow. I think you got to go back to the Depression, I think it was. And I think it happened like one other time where literally 1 ounce of gold, the dollar amount was higher than the Dow. We're at a Dow 41,000 right now. So I think that's kind of ridiculous, like $50,000 gold in 10 years. I think it's possible, but even if that's completely way off base, let's just say I'm way off base on that, and that's absolutely ridiculous. $10,000 gold, that's pretty amazing. That's like a 2-3x move from here over the next 10 years. And to me, that is the world that we're heading into. And we're heading into that world because there is no way to get ourselves out of this other than Great Depression, economic collapse, or inflation. I mean, we can get into the details of what that means, but I honestly believe that policymakers will eventually think all this through, as I've been doing for years and years, and realize that there's only two choices. It's, do you want to collapse the economy and maintain the value of your currency, or do you want to inflate it away? And to be clear, one of the things I said in the outline is, why does this work? Because it's not just the U.S. This is a global phenomenon. Italy has higher debt to GDP than the U.S. Japan has higher debt to GDP than the U.S. Spain has higher debt to GDP than the U.S. France, we can go on and on and on about these. This is a sovereign debt bubble, and you can only get through it one of two ways. You can let it all collapse and let the system blow up, which is going to be absolutely 1929 all over again. Or you can inflate it away. But, and this is key, and I also sent over a note of an IMF paper about how the US got out of GDP to deficits in 1920. So this was a really good IMF paper. It was looking back, it said, did the US really grow itself out of its World War II debt? And it went back, it analyzed the situation, and it did all this statistical stuff and all this IMF, PhD, regression type stuff. And basically at the end of the day, they said, no, they didn't grow themselves out. They inflated their ways out through surprise inflation, and surprise is the key word, and yield curve manipulation. And I think that's what's coming. Surprise inflation. They're going to try to talk down inflation. It's not coming. Fed is resolute. We're going to keep a lid on it, But I think when like Besson and Powell have their breakfast and all this stuff happens, like they're gonna be like, okay, look, we're between a rock and a hard place, and the best out is sustained, substantial surprise inflation. Like I'm talking 5-6% annualized for the next 3 to 7 years. I'm not talking about hyperinflation or 10%, or the dollar is going to become, the Zimbabwe currency or whatever, or like that. That's not what I'm talking about. But what I'm talking about is that we're going to have and that's what the bond market is sniffing out. And that's why yields keep going up, because they're saying, look, the bond market is the one who gets killed in this scenario. What does well? Equities, especially, more than equities, gold and Bitcoin. And, I think real estate ultimately will do well as well. Basically, anything priced in dollar terms does well. It's all the same trade, anti-dollar trade, long assets, short bonds. Exactly. I mean, I don't usually, when I go on podcasts, like I wrote a book. It's called Quaz. It's a financial thriller, and it's basically like a fictional narrative of a financial collapse, and it involves a lot of intrigue and corrupt central bankers. And there's a guy named Hao Zong, who's like the head of the People's Bank of China, and he starts selling, U.S. Treasury holdings into the market, and there's a market collapse, and everybody starts flipping out in the book, because unlike in other collapses, the dollar's not going up and bond yields are going up. And it's like, that's literally like the climax of the book. I don't want to give too much away if people want to buy it. But look, so I understand these dynamics. I mean, I wrote that book in 2022 years ago, and then people talking about all this stuff happening now. But basically, I've thought through this so much for so long. I mean, like, I think the first time I came on Forward Guidance with Jack, like I was talking like, this is where, I think the title of it was Final Straw in the US Dollar Debt Spiral. And I was talking like, we are in an unsustainable path. Like people need to realize like this cannot go on. And I talked about a 2027, 2028 timeframe for when the, what hits the fan, because that happens to coincide with like Social Security. And in Social Security, that cannot be understated. The Social Security impact of what's happening with Medicare and Social Security, because we literally, and I go through the Treasury data, the Social Security data, the CBO data, like we literally peaked in the Social Security Trust Fund in like 2020, and we started drawing that down. That has a couple of effects. Number one, if you look at like total government debt, like 37 trillion, a lot of it is intergovernmental. And you know where it is? It's to the Social Security Trust Fund. We were growing the Social Security Trust Fund basically from the 80s until 2020, because, more was being paid in than we were paying out. We started drawing that down in 2020. We're now drawing down the Social Security Trust Fund, which is actually a reduction of Treasury expenses, because so the Social Security Trust Fund, for those that don't know, it is invested in a unique type of treasury bond, a non-public treasury bond. It's basically a bond that the Treasury issues that only the Social Security Trust Fund can buy, and they get an interest rate on that. And that goes into government accounting and deficits and everything. As the Social Security Trust Fund gets drawn down, that actually means the Treasury has less interest to pay to the Social Security Trust Fund. So it's actually like bullish on US government accounting. But in reality, what's happening is we're going to head to zero around the end of this decade on Social Security Trust Fund. And at that point, like it's a cliff. And a couple things to remember. Number one, Social Security can only be paid for by paid in Social Security according to law, which is different.
So they can't monetize, like the Fed can't monetize it. Okay.
No. And the Treasury can't just say we're gonna pay it, and like it needs a congressional action to change it, which is different than Medicare. And so all this stuff is going on, and I'm looking at all of this stuff. I really, for people that don't know me, so I've worked 25 years in financial services, graduated college in the late 90s. I know I don't look it, I'm a young, handsome guy. I actually turned 50 years old this year. But I've been through some markets, right? I've been through the .com, I've been through GFC, I've been through this, and I was sitting at home during the pandemic, and I started like getting into this, and I started looking at the expansion of the Fed balance sheet, and I started saying, look, pre-GFC we're like an $800 billion Fed balance sheet. Post-GFC, okay, we're up to a couple trillion. Pandemic happens, we go up to 9 trillion. I'm like, this is. And I'm like, what are these obligations? I'm like, what really are they? Not like, I know they're big. Let me actually go to the websites, go to the documents, research it, figure out what's really going on here. And I'm like, we're heading for trouble, man. I mean, like there's no easy way out of this. And so there really is a big problem that's occurring here. And that goes back to my, there's 3 scenarios. There's a scenario where we start to address it and we get through it. There's a scenario where we don't address it, and I think we still have a few years of this inflationary stuff. And then there's a scenario where we just, don't address it or try to do austerity or something like that, and then we collapse. But I think both of those first 2 are bullish equities in the short term. One of them is bullish equities long term. The other one is actually uber bearish in the medium term, which is like a 2027, 2028, 60, 70, 80% equity collapse. So I don't know which direction we're going to go, but I think those first 2 all point to we still need to inflate. We still got some balance sheet room. The entitlements aren't coming due yet. We've got a few years on that. And what we need to do is we need to spend, but at the same time, put in a way out of this mess during this short window that we have. And, we will see what happens. But as long as those first 2 occur, at least for the time being, we're positive. In a year, I'll look back and say, okay, did we just brush it off and then I see a big collapse coming? Or did we actually make some movement on the manufacturing needs of national defense, on addressing the budget deficits, stuff that goes back to Triffin's dilemma, Bretton Woods, all that stuff? Like, did we actually make some headway on that can be fixed over the next 10 to 12 years? Or did we just push it off, in which case we're really heading for trouble? So that's where I see things at right now.